Thank you, Doran. Good afternoon, everyone, and welcome to the continued educational webinar series by Algorithmic Traders Association. My name is Alex Christoph. I'm the Director of Educational Programs with Algorithmic Traders Association. And in this webinar, we're going to consider the most typical fallacies and delusions associated with backtesting, in order to get a better understanding of the limitations of applicability of this important method of assessing the performance and robustness of trading strategies. For those who joined our webinars only today, I strongly recommend to watch the recordings of our previous webinars, where we already discussed the essence of systematic trading in general and backtesting in particular. Generally speaking, all fallacies about backtesting can be more or less easily classified into two major categories. Followers of the first one believe that if a strategy has been backtested and the backtested performance was good, then the strategy will undoubtedly bring them money in the future. Their opponents say that any strategy with good backtesting results will inevitably lose in real trading because such a strategy was surely optimized. As you can see, these are two opposite extremes, and as is often the case with any extremes, both are wrong. Let's try to see the reasons why these fallacies are so popular and understand to which extent they are correct. Let's start with a positive fallacy, which is so popular among systematic traders that if we can see a good backtesting result, then the strategy will definitely make money in real life. There are three main reasons why this implication may not work. First, the backtesting might be done with wrong assumptions about the technical issues associated with the particular market and the instrument. Second, it might disregard certain requirements which make the test statistically insignificant. Remember that systematic trading is all about statistics. And third, it may suffer from insufficient understanding of the market processes and major changes in markets. If we mean incorrect backtesting results because of various technical issues, then this is probably the problem which is the most common on the one hand, but on the other hand, it can be resolved in the easiest way. A researcher should simply be careful with various settings of the backtesting software which aim to reproduce the live trading environment and check if a particular trade can be placed in reality. Typical issues of this kind include missing slippage and commission costs, unrealistic timing of entries, for example, sending orders during time when the exchange is closed, and various issues with position sizing and money management. We will consider all of these issues in more detail in one of the future webinars, but let me repeat that although the importance of these issues is high, they are the easiest to be fixed. Issues associated with insufficient understanding of statistics are very common, and unlike simple technical issues, they are relatively hard to be identified and consequently fixed. Most systematic traders and developers know that the more the data is taken into consideration, the more reliable the result. This is true. But besides the very amount of data, there are other requirements applied to the backtesting results under consideration in order for them to be considered as valid. Let's consider an example. Imagine that we have two equity curves. Which one is better? I'm sure that all of you will choose the leftmost one. Why? Informally speaking, it looks more smooth. If we try to describe it a little bit more formally, we'd rather say that the gain in the leftmost strategy is generated more or less equally in equal periods of time, while almost all profit, and the rightmost one, is generated within just less than 10% of the time, and the rest of time the strategy does nothing. Statistically speaking, we can apply various statistical analysis methods to a smooth equity curve, okay, so-called smooth equity curve, or the one where gains are distributed evenly along the time axis. In this case, we can discuss various metrics like average gain, average trade value, standard error, variance, and standard deviation, and all of them will make sense and will help understanding both the past performance of the strategy and, in some cases, its possible behavior in the future. Theoretically, we can apply the same analysis to an equity curve which does not conform to this requirement. But in this case, all metrics won't make sense, although they can be calculated. Remember a joke from one of our previous webinars about measuring temperature in a hospital. Someone is dead, someone is in hot fever, but on average, the temperature is normal. Same here. We can calculate statistical metrics over a data set which is not suitable for this kind of analysis, but the results simply won't make sense. This is, of course, the simplest example of the requirements to the backtesting data, and we consider many more in our special educational course for systematic traders, but at least I hope that this example gives an idea about what to be very careful with. Now, let's discuss the most overlooked issues, which origins are in insufficient understanding of market structure and major changes in price behavior associated with it. This topic is very complex and, of course, is well beyond the scope of our today's webinar, but in essence, it can be explained in just 3 steps. First, we need to understand that all market models, without any single exception, have certain limitations of applicability. For example, a model which exploits opening gaps in the stock market cannot be used to trade Forex because there are no opening gaps there except for weekends. Again, this is a primitive example, but it clearly shows that models have limitations in applicability. The limitation of applicability of market models is determined not only by differences in the market structure between markets, but also by changes in this structure in the same market. Again, this is a very vast and very complex subject, which is thoroughly considered only within our special educational course for systematic traders. But of course, we can illustrate it with another simple example. Compare the same market, for example, stocks market, as it is today as it used to be 20 years ago. That time, you wouldn't find a lot of market participants which are very active today. For example, high-frequency traders, arbitrageurs of various kinds, and many more. Why? Because the market structure changed, and it allowed for more new market participants to emerge. Therefore, some models which are relevant to today simply wouldn't have ever worked before, and thus backtesting them doesn't make sense. Finally, I'd like to again draw your attention to the fact that insufficient understanding of changes in the market structure often leads to failure of even successfully backtested models. It's not uncommon when a strategy with excellently looking equity curve went into a drawdown sooner or later because this strategy was not designed to be used within the new, changed market structure, and the author of the model doesn't provide for every contingency associated with this problem. Now, let's discuss another fallacy, which is also very common, mostly among discretionary traders and long-term investors. In the most extreme form, it sounds like Backtesting is only curve fitting, and only live results may prove that the strategy is correct. If we give it a proper consideration, we can point out at least 3 flaws in this statement. First, it confuses backtesting with optimization. Second, it totally denies statistics. And third, and perhaps the most important, it doesn't suggest any alternative. Let's now consider all 3 issues in more details. First of all, let me point out the difference between backtesting and optimization. I'd like to draw your attention to our previous webinars once again, as one of them was dedicated to the definition of backtesting. But in brief, backtesting is only simulation of trades on past market data, and optimization is finding a specific set of parameters which deliver the best performance to the strategy. Of course, they are used in conjunction with each other, but essentially they are completely different tasks with different goals. Thus, it is incorrect to say that any backtested strategy is over-optimized. The second fallacy, typical to discretionary traders, is almost total denial of statistics. It is not surprising, as with discretionary trading, it is virtually impossible to apply any statistical analysis to trades, as the very reasons for placing them are different almost every new time. However, in case we test a system, which means a well-defined set of rules and excludes human discretion, then statistics becomes a very powerful tool which is able to prove or disprove whether the strategy is able to work under certain market conditions. Don't forget that we discussed before about the limits of applicability of any strategy, and don't let yourself to go into overly optimistic self-delusion. Finally, and perhaps the most important, denying backtesting unfortunately doesn't suggest any alternative. Imagine that we have noticed a certain phenomenon in the market which seems to be repeating, and we want to make money with this phenomenon. However, if we deny backtesting, then we don't have any idea about when this phenomenon first appeared, under which market conditions it was more or less prominent, and in the long run whether this phenomenon has chances to be observed in the future or disappear soon. Testing the trading idea only live is not the best way of proof of concept, because it might be expensive, and very expensive. Let's now quickly refresh the 2 major types of delusions associated with backtesting. If the backtesting looks good, then I'm sure to make money with this strategy, and if the backtesting looks good, it means that the strategy was over-optimized and won't work in real life. I hope that now it is clear that both diametrically opposed opinions are incorrect, and the truth is somewhere in the middle. Let's try to look at backtesting without prejudice and summarize the well-balanced opinion about backtesting without any fallacies and delusions. Backtesting is only a tool with its limitations of applicability. In case this tool is used properly, with full understanding of these limitations and without overly optimistic self-delusion, then this tool can be very helpful for trading strategies research and development. And without clear understanding of the essence of backtesting, its limitations, and especially forgetting that market structure is in the constant process of changing, backtesting may deliver misleading results. On the other hand, any tool which is used the wrong way may be really harmful. As we mentioned several times today, backtesting itself and associated issues are complex subjects. They cannot be discussed in all details within a single webinar or even in a series of webinars. Thorough study of backtesting market structure, methods of finding trading ideas, and designing automated trading systems is included in our special educational course for systematic traders. It is possibly the most exhaustive educational program which covers all issues associated with mistakes in technical backtesting, statistical analysis, and even market research. The goal of the course is to train an independent market researcher who is able to find trading ideas, design strategies based on these ideas, and to properly manage risks. So it is far more than only backtesting. Now I would like to say thanks for your attention, and in case you need more information about our educational program and certification, please feel free to write to info@itssn.com. You can also do that by filling out the form at the classes page of the site. And now the main part of the webinar is over, but for interested attendees, I'm going to say just a few words about the CAT course program. So if you want to learn more, then simply please stay in tune. And after that, I will be happy to answer all of your questions. The CAT, or Certified Algorithmic Trader course, consists basically of 3 stages. The first one is working mostly with market analysis. The second one is dedicated to algorithms design, backtesting, exactly the subject of today's webinar, and optimization. And the third stage, perhaps the most sophisticated, the most complex one, is completely dedicated to portfolio design, money management, and risk management. Within the first stage, students learn the methods for analyzing the market and develop a very special outlook to the market. We consider market as a superposition of actions of the market participants, of humans. We already held a webinar which was dedicated exactly to this market concept, so you can always watch the recorded video of this webinar in our YouTube channel to understand more about this market concept. Next, we learn how to identify ideas that may work in the market. And finally, how to transform these ideas into algorithms. For many students out there, especially those with good programming skills and with vast past background in automated trading, this may become even the end point of the course, because after that, the student is potentially able to design his own trading strategies. But normally we proceed to the second stage, where we discuss how to properly do backtesting. We discuss all the issues of all 3 natures that we discussed today and how to avoid them. And also we consider optimization. We consider optimization as a tool for researching the strategy properties rather than just over-optimizing the strategy parameters to some subset of market data. And finally, we discuss how to create robust portfolios of different markets, different instruments, different strategies, how to manage operational and systemic risks within a rather complex portfolio which is traded automatically, and a knowledge which sometimes is the most useful, unfortunately, how to identify the moment when to switch off a system, even if this system used to work excellently. The requirements to the students are more or less flexible. We expect a student to have some knowledge in very basic knowledge in mathematics, especially understanding statistics. Of course, we require some very basic programming experience. We do not expect everyone to be a decent programmer. It is not required. But at least you have to understand, for example, the if-then-else statement. We work normally for 3 months, sometimes even more. The classes are online and we meet on a weekly basis. We work in very small groups of no more than 3 students, normally less. And please do not think that this course is going to entertain you in some way. No. Every student who takes this course is going to work real hard, because between these weekly live online classes there is plenty of work with support from my side, but this is the individual work, individual development of a true market researcher, of a true systematic trader. So now let me say once again thank you for visiting today's webinar, and now I'm ready to answer questions. What margin of error should be attributed to backtesting results over a 48-year period in stocks? Well, it's a difficult question because first, there is no information about which market you mean. For example, well, 48-year period is quite a long period. In this case, you need to be very careful about delisted stocks, about splits, about changes in the regime of work, changes in requirements to accounts, to brokerage commissions, transaction expenses, and so on. So I wouldn't say that this could be a good idea to test, to make such a test over the total 48-year period in general in one chunk, because market was very different during this period of time. What is your opinion about forward testing? Well, forward testing depends on what you mean by forward testing. If you mean simply that we first backtest on some data and then we make a proof of concept on some new data that was not included into backtesting, then of course this is a good idea. This is always a good idea. Sometimes by forward testing is confused with walk-forward optimization, a method when we re-optimize the strategy parameters using some interval of data, for example 1 year, then we try to trade using the new parameters for 3 months, then we re-optimize, then trade for 3 months, re-optimize, and so on and so on. This method normally does not only does not provide any edge. Normally a strategy that is traded this way delivers far worse performance than a strategy that was tested on as much market data as possible. This is more or less obvious if you recall what we discussed today. The market changes and the various market conditions, various market environments corresponds to various behavior of the strategy during these periods. So if you think that you either accounted for all possible market conditions within your strategy, then okay, this is possible. to make a, let's say, dumb forward test. This will tell you something. However, there is a very large class of strategies that are excellent strategies, which simply don't work under all market conditions. If you have a rule which allows to switch the strategy on and off, then of course you have to be simply very careful and reasonable with the choice of the data for this forward test, because there is a chance that you simply backtest first using one market state and forward test on another. So, but again, simply common sense really helps. How important is a Monte Carlo type of analysis when backtesting? For example, looking at numerous simulations of random shuffling of all trades. Okay, at Monte Carlo, and there are many more other statistical tests, were originally designed to analyze processes which can be considered as random. Well, we all know that there are no truly random processes in the universe, but let's say pseudo-random in a certain sense. For example, with normal distribution, with any other kind of distribution. In this case, yes, such a test would make some sense, but the market is not a random process. Every tick in the market has its meaning because someone initiated a certain trade at this moment. This is our problem, that we don't